Applied Materials stock is down over 14% today after their recent earnings report, in which the stock was at $188 yesterday, but now it's at $161. Right now, the company is trading at $130 billion market cap or so, has a dividend yield of 1.14%. And with that being said, we're going to get into the earnings report of this company. Then I'm going to be using my intrinsic value calculator to determine if we should be buying the stock today after this recent drop. But first, let's talk about what Applied Materials does. Applied Materials primarily manufactures and sells equipment used in the semiconductor, display, and solar industries. The main products include equipment for semiconductor wafer fabrication, such as deposition, etching, and inspection tools, as well as systems for flat panel display and solar cell manufacturing. They also offer services and software to support these products. So they basically sell equipment for people to make their chips. So this is a semiconductor company mainly, and they make the equipment for other companies to make the chips. And before we get into the rest of the video, if you guys please hit the subscribe button. I'm making these videos mainly for you guys and to help me learn in the process and get better at investing over time. So please go down below. Right now, we only have 10% of my viewers are subscribers, so all you have to do is please just press the button. It doesn't cost you anything. All it costs you is potential to learn more about investing for the future. So let's get back into the video. So thank you guys. Please subscribe. And taking a look here at the semiconductor value chain, we can see here Applied Materials is one of the companies that do create these equipment. And as we can see here, all these other companies use the equipment of Applied Materials. So also another thing about Applied Materials is one of the most diversified semiconductor equipment companies. As we can see here, they offer all of these other equipments compared to some other companies. For example, ASML only offers very limited equipment, and Applied Materials is just a much more diversified equipment maker compared to all these other companies in the semiconductor industry. So this company is a very diversified company, so that can be a good thing, but also at the same time, it does limit the growth of this company. Taking a look at their earnings report right here, we can see that Applied Materials reported a $2.48 of earnings per share and $7.3 billion this quarter. So those were both beats where they were expected $2.36, so that was a beat by 12 cents. And the sales beat by $80 million, so this company did beat on both the top and bottom line for this quarter, but the biggest problem here was the guidance with Applied Materials. Looking at the adjusted earnings forecast, they have a forecast of $2.11 and revenue of $6.7 billion. But compared to what analysts wanted, look at how terrible this guidance was. Analysts wanted $2.39 for next quarter, but Applied Materials said they're only going to get $2.11, so that's a pretty big miss. And also on the revenue, we can see here, this is just also terrible. $7.33 billion in revenue was expected by Wall Street, but Applied Materials only says $6.7 billion. So this is a very bad next quarter, they said, because they're operating in a dynamic macroeconomic and policy environment, which is creating increased uncertainty and lower visibility in the near term, including for our China business. So despite this, they did say that they remain very confident in the longer term growth opportunities for the semiconductor industry and Applied Materials. So with that being said, they are seeing some big headwinds in the short term, as we see here. This is a very big miss. I'm surprised they missed this much on that guidance, but maybe they're being a little bit conservative. They did say uncertainty. They didn't say that they're necessarily going to do bad. I think this decrease in their guidance might just be because of the uncertainty of the future. I'm not saying that they're going to get what Wall Street was thinking before, but I would expect them to beat this by a decent amount, honestly, next quarter. I don't see them getting $2.11 and $6.7 billion in revenue. I expect them to beat on both those pretty decently. I just think they reduced this because of uncertainty in the future, and they're not 100% sure. And here's the main reasons why AMAT is down, Applied Materials. Like I said, disappointing guidance, pretty bad guidance. Also, China-related concerns. The company's management cited increased uncertainty, like we said. which is a major concern for investors as China is a major market for semiconductor manufacturing equipment. The company also mentioned delays in getting approval for exporting some technologies to the country. So that's a big thing with investors. Also, slowing demand from key customers. The company also noted non-linear demand from its leading edge customers. This suggests that some of the biggest chip makers are taking a more cautious approach to spending on new equipment, which can impact Applied Materials sales. So they're saying that their key customers are slowing down their purchases on equipment for the future, and that's the main reason the stock is down, because of that uncertainty of the future next quarter and their guidance. This quarter was a very good quarter, it's just the guidance was very bad, and that's why the stock is taking a major hit today. Taking a look at the revenue of Applied Materials, over time it is increasing. It is decelerating growth though, I will say that. And as we can see here for next quarter, we see a pretty big decrease expected in that revenue. So they are expecting a pretty bad next quarter. And also for the earnings, we can see once again increasing earnings per share, but once again decrease next quarter. They're expecting a pretty bad fourth quarter, so keep that in mind maybe for the next few months. But honestly, I don't think this is as much of a deal as people may be thinking, because I think long term this company still looks pretty decent. Taking a look at the moat of this company, while Applied Materials is in a pretty competitive industry, I would say I think they have some good competitive advantages, like the technology they have. They do have a lot of patents, and they spend a lot of money on research to stay ahead of some of their competitors. Also, another thing is the one-stop shop. They don't just sell one type of machine, they sell a whole range of equipment, so they're very diversified. So it's going to be hard for them just to fall apart, which makes them a critical partner for major chip companies like Intel and Taiwan Semiconductor, who rely on many of their solutions. Also, steady income. A large part of their business comes from servicing and upgrading the equipment they've already sold. So they do have some recurring revenue, so it's not necessarily going to be a very cyclical type company. While Applied Materials is cyclical because they're in the semiconductor business, it's not necessarily going to be too cyclical because they do have a steady income source with that. Taking a look at the financial health of Applied Materials, we get 7 out of the 7 key metrics that I like to look at. Taking a look at the PE ratio, we have a pretty low PE ratio at 19 compared to the market average of 25. And this means you're going to be paying $19 for $1 of earnings per share over the past year. So this is a pretty cheap valuation compared to the market. Also, the forward PE ratio is less than 30 at 17. Both these metrics look pretty good and shows that this is undervalued compared to the market in terms of valuation. I'm not saying it's necessarily undervalued and you should be buying, because I just also made a video that is basically explaining just because the PE ratio is low doesn't mean you should be buying this company. Taking a look at the revenue growth, growing at 13% each year for the past 5 years and 22% EPS growth. So this company is growing at double digits and pretty good growth, but I would like to say that both these growth segments of the revenue and earnings per share is starting to decelerate, and only in this past quarter, year over year, they grew 8% sales, and then the earnings per share was low double digits. So with that being said, it's decelerating growth, but they're still growing at a decent rate, I'd say. I also like this, that they're buying back a lot of shares, about 3% each year. This means that you're going to be owning more of the company. If you buy into this company and you are a shareholder, you're going to get a greater percent ownership, which will in turn increase the earnings per share over time. Also, the debt to equity ratio is at a pretty good rate at 35%. It's nice and low. We want this less than 50%, showing that they have less than half the amount of value of their equity is debt. So this looks good for the debt to equity ratio. And also, analysts still expect this company to grow about 9% for the next 5 years. So this looks like a pretty decent financial health company. The only thing I really don't like about this company is the possible competitive advantage in this space. Number one. Number two, the cyclicality of the semiconductor business. I'm not saying you should just not buy semiconductors. I've been interested in this company. I had basically where I would be buying this company if it got to $120, I remember, and it got close to it during this year, but it didn't quite get there, so I didn't buy any. And with the case of the cyclicality of the semiconductor business, I do own another equipment manufacturer in ASML, so I'm not opposed to buying Applied Materials. It's just I think the diversification of this company, while it is safer, it's just not growing as fast and it's decelerating, and that's the biggest problem I have with Applied Materials. So with that being said, I'm be going and taking a look at my intrinsic value calculator to get a fair value price and to see if we should be buying the stock today and see how much we can make in the future. Now, taking a look at my intrinsic value calculator right here, I have to use assumptions for the future for my intrinsic value calculator. I'm going to have three cases: the bear, the base, and bull case. So for the bearish case, we need to do assumptions that are probably not going to happen but are on the lower side just in case. So for the bearish case, for their annual revenue growth rate, I think for this company, they could grow at 5% each year, which, because I think 5% is pretty fair, where they're growing at 8% each year right now, and I think in the future, 5% would be a pretty low place for Applied Materials to be at, especially as AI continues to grow, and I think 5% is fair. Now for the base case, I'm going to put 7%, and for the bullish case, 9%. The reason I'm going to put 7% for the base case is because right now they're growing at about 8% each year in the past few years, so it's slowing down a little bit, and I think 7% can be fair for this company. I think this company is a little bit too diversified to where they're going to grow insanely fast. I'm not saying diversification is bad for this company. I'm just saying that 7% is pretty fair for the revenue growth, and then 9% for the bullish case. Now, going over at the profit margin right here, we can see the profit margin has been going up over time for the past 10 or so years. Right now, it's at about a 24% profit margin. So with that being said, I think for the bear case, I think a 21% profit margin is fair. If increased competition or something with macroeconomic, something bad in the next 5 years happens, say there's more tariffs or something like that, I think we could see this potentially decrease. For the base case, I'm going to put a 25% profit margin. Right now, they're right near that area, and I think they could potentially grow this just a little bit up to that 25% mark. For the bull case, I'm going to put 29%. For the future PE ratio, right now, like I said, they're trading at about a 19 PE ratio, but for a company that's, I think, could grow at 5% for the bearish case, with a PE ratio, I think that's fair. I would say a 14 PE ratio if a company grows at 5%. Now for this base case, I think they should get a 17 PE ratio for growing 7% each year, because right now they're trading at about a 19 PE ratio, and their past revenue growth has been about 8 or 10% or in that area for the past few years. So I think 17 PE ratio is fair. Now for the bull case, I think 20. Now for the shares outstanding, I think they've been buying back at about 3% each year. I think they're going to do that basically still, in which I think for the bearish case, they're going to buy back 2%, bullish case 3%, and base case 3%, and bullish case 4%. With that being said, I get total annualized return for the bearish case at -2%, for the base case 8%, and for the bullish case 18%. So right now, I'm not buying this company, but personally, I want to see this probably get back to like $130. If it got to under 130, I would definitely start to a position in this company. Like I said earlier in this video, I wanted to buy this company under 120, and the fundamentals have slightly gotten better over time, so it makes sense why now my price target's 130. So thank you guys for watching this video on Applied Materials. Please subscribe, hit the like button, comment down below, give me some feedback on this video, and thank you guys. See ya.